Seeing this video had 2.3 million views, I thought it might be appropriate to do some comments on it. The gentleman proposes 7 strategies for novice investors, of which I think 6 are incorrect. But to cut to the chase, if you are a new investor in the stock market, what you should do is put 90% of your available surplus funds in just an S&P index fund, that's low cost. Put 10% of your funds into individual shares that amuse you, that you know something about, but you never do any basic research. You should never sell the S&P 500 index. But that's the bottom line. But let's go through each of the comments that the gentleman has provided. The suggestion here to invest in safe stocks is really just trading off risk and return. If you invest in a safe stock, you can expect or a safe index fund, you can expect a fairly modest return. One of the most fundamental things in the share market is that risk and return are related. The more risk you take, the higher return you can expect. You're paid for that volatility, for that uncertainty in the investment. I think the advice to put 80 or 90% into ETFs is good advice. That way you get some exposure to equities, some exposure to the share market, without risking all your capital there. It would be a very bad idea to put 8% of your money into Coca-Cola or a bank, but an ETF, which is diversified among, say, the top 500 companies in the United States, is a good idea. You get some feel for the stock market with the majority of your portfolio. Here the notion to stay away from any industry grouping just repeats, I think, the first point. In that once you get away from an undiversified portfolio into some particular industry segment, you're exposed to more risk. Again, you may get more return, but if you're a novice investor, being in a high-risk portfolio is not such a good idea. So the advice to stay away from a particular industry segment for your 90% investment is good advice. This is not appropriate advice. If you're a first-time investor, unless you have a particularly complex tax situation, you don't care whether you get dividends or whether you get capital appreciation. It makes no difference to you whether you receive a $10 check in the mail or whether your investment in that particular firm goes up $10 because of changes in the share price. So there's no need to look at shares or companies that have a dividend flow. The notion that you should then reinvest the dividend is also not well formed. That confuses the investment with the financing decision. If you have $10 in your wallet and it's surplus cash and you want to invest it, you should invest it. Whether that $10 came from a dividend payment or working, doing some work, it makes no difference where the money came from. The question is, what should you do with your surplus cash flow? I think this is the worst possible advice you could give to a novice investor, the notion that you should buy when everyone else is selling. The reason everyone else is selling is there may be some change in the market, some additional information which has led to a drop in the market. But the notion that a first-time investor will have some information that the market doesn't already know is just not supported. As there's lots of money involved in this, there's quite a literature on it. It would be well worth your while to Google the semi-strong efficient market hypothesis. And that suggests that unless you know something the market doesn't know, then you have no advantage. So if everyone is buying, you should not buy. If everyone is buying, you should not sell. If everyone is selling, you don't buy. If everyone is selling, you don't sell. If you have surplus cash that's available and you want to change your risk position by investing in equities, then you should buy. There is no point in trying to time the market and think there's some sort of momentum in that because everyone is selling, I should buy, or because everyone is buying, I should sell. Under no circumstances should you pay attention to the news or do any research. The notion that you, sitting at home, will have some information that all the bankers and all the investment managers in Wall Street have is not supported. There is no point you opening an Excel sheet and trying to do the balance sheet or the profit and loss statement of a company you're interested in investing in, because that information is already in the market. The notion that something in the news, you can trade on something in the news, again, is not supported. I recall back in Australia, an expose in one of the leading businessmen there showed that he was involved in some corruption and some inappropriate dealings. The next day, the share price went up because the information in the market suggested it was less corrupt and less inappropriate dealings than what the market had priced. So the notion that you should sit and watch the news or download information from the Securities Exchange Commission is just not supported. You are wasting your time. You buy it at the share price that impounds all the publicly available information that has come from all those analysts. The reason you would not invest less than $500 has to do with transaction costs. That if a transaction costs you $10, then straight away you're losing 2% of your money just by buying that $500 asset. The argument against it is that if you only have $1,000 spare, you've put $900 into an S&P index fund, which is fine, and you have $100 left over. That even with a $10 transaction fee, having $90 invested in a single company can be useful. In particular, it would show you the volatility associated with single company investments. So you invest $90, you may see it go up 10%, one day, then down 15% the next day, if it's a particularly risky investment. But the value of seeing that volatility, even though you had to pay $10, 10% of your portfolio to see it, can still be worthwhile, just so you understand the risks and returns of investing in a single company. Well, that's about it. Just to repeat myself, if you are a first-time investor, you have $1,000 spare, put $900 in an S&P index fund, invest $100 in any company that amuses you, and the reason for that is you get some feel for the volatility of a single company. Never do any research, never pay any attention to the news, never sell the S&P 500 index, but have a look at the 10% investment to see that go up and down and see how easy it is to lose money, how easy it is to make some money, and how impossible it is to time the market.